Welcome back to Higher Ground Financial Group Radio. This is Daniel Razvi and Imran Razvi. We're going to talk a little bit about risk, fees, and taxes and really focus on retirement. But today we had some questions about the new administration, Trump coming in and what he's going to do and how it's going to affect people's retirement. So if you want specific questions that are uncensored and not on the internet, then you can go ahead and go to our website, riskfeestaxes.com. That's riskfeestaxes.com, and our tax attorneys will be happy to give you what their opinion is on the new topics and the new administration, what's going on. But we'll tell you some things of what our thoughts are now. So, Trump fans are saying, oh, there's all these promises Trump is going to make. Let's see what happens. And then the people that don't like Trump are saying, all these threats Trump's making. Let's see what happens. Either way, we're not sure what's going to happen because he can't just do it all himself. I mean, you can try. There's a lot of things that the president's done with the executive actions and things like that. But really, the proper way is to present a bill, or present your thoughts, and legislator passes a bill, and then you sign it, right? That's how it's supposed to be done. And that's normally how tax legislation is done. There are many things that the Trump administration has been promising to do that will probably be attempted, at least through executive order, but probably most of the tax things are going to have to be passed in a tax bill. So we'll have to revise our opinion on what's going to happen once those bills are actually passed. But some of the top things on the table that have been talked about are extending the Trump tax cuts, and we'll get to that in a second, or potentially eliminating taxes on tips, or eliminating taxes on Social Security, and maybe even reforming some of the corporate tax rates, lowering the corporate tax rates even further than they already are. And so those are some things that are talked about. And there's also estate taxes that are changing. So if nothing else happens, if they don't end up passing any law, because we know that Congress sometimes is very good at passing nothing, and there's not a very big majority of Republicans in the House, so it only takes a few to disagree before the law doesn't get passed. So if nothing happens, then where are we, Raz? We're right where we were just a while ago, meaning that the tax cuts are going to expire at the end of the year, and going back to what it was beforehand, which means your tax rates are going to go up, the bracket's going to shrink, and the estate tax is going to shrink quite a bit. And so that could be very dangerous if you were approaching the $7-8 million limit. Right. So right now, the estate tax exclusion is really high. It's $14 million or so. But if nothing gets passed, then in 2026, that drops in about half. So $7 million. And you might be listening to this show thinking, well, I don't have anywhere close to $7 million saved. Maybe you have, I don't know, $4 million of assets. If you have something a little less than $7 million, that doesn't mean it's going to stay there. Hopefully, it's growing by more than what you're spending. And in all likelihood, even if you assume a small rate of return, you're still going to be above that $7 million by the time you pass away. So it's very likely that many people will be affected by that if it does not get extended. And my suspicion is, if they have to make a compromise somewhere, if the administration does get a tax bill on the table to extend the income tax cuts so they stay the same, they have to get some compromise from somewhere else. And one of the easiest places to get that compromise is to leave the estate tax how it is, let that expire, because the majority of Americans do not have more than $7 million of assets. It would certainly be nice as a tax attorney. It's nice when my clients don't pay any tax. So it's nice. It would be nice if we got rid of all the taxes altogether, but we know that's not going to happen. So what is realistic? I think there is a really good shot that we'll see the tax cuts extended on the individual side. Right. But it's quite possible that some pieces of the law did not get extended. One of those could be estate tax. We could see some changes with the excise tax, the net investment income tax. And so we'll keep an eye on that. But you do have today's taxes that you know what those are. So anything you can take advantage of today, regardless of what happens in the future, you're not going to be taxed again on that money if you've done a conversion, for example, to Roth. And we get the question all the time, Raz, well, what can't the government just change its mind? Can't they, after at the end of the year, can they go ahead and tax me again or double my rates on all this money that I've already paid taxes on? Yeah, I've already paid taxes and now it's Roth. Can they go back and tax it again or change the rules? Well, they can't change the rules on that, because if they do that, then there's no promises that are kept. I know government doesn't keep a lot of promises, but laws are a certain way that if you create a law, it can only go forward. You can't go and backdate a law. There have been some times where they did backdating for some benefit that saves people money or gives people an extra refund. But anything that's going to cost you more money has to be prospective. It cannot be retroactive. So anything that they pass, even if it was a tax increase this year, it would only affect future after the law goes into effect.
Except for benefit, like we just had the WEP, right? The windfall.
Yeah, the windfall elimination provision and the GPO, the government pension offset. Those were provisions in Social Security law that said if you were subject to certain government pensions, you were excluded from Social Security, or you had a limited amount of Social Security.
Even if you paid in Social Security, you wouldn't get it back.
Yeah, or maybe even if your spouse had Social Security and then your spouse passed away, you wouldn't be able to collect the survivor benefit because you also had a government pension. Those got repealed, and that was passed, and that was actually retroactive all the way to the beginning of the year. It was passed at the end of the year in 2024, and it was retroactive all the way to January, I believe. So people that were affected by that are going to get a lump sum Social Security check for 12, 14 months.
Are they going to file for that, or is it going to be automatic?
It should be automatic, but if it's not, you should definitely check that out. If you think the GPO or the WEP applied to you, then you go ahead and check that out, because sometimes the government does not notice what it should pay you. And we saw that happen with the stimulus checks. There was another news item that went out recently that a lot of the stimulus checks are going out automatically, but they're 3 or 4 years late because they're for people that were eligible but did not claim them. And it took them 3 or 4 years to figure out who those people were to be able to pay them. So if you think this applies to you, you should definitely reach out proactively to the Social Security Department and try to get those payments out.
So on the same note, on the same note, if they had just passed the WEP and saying you can't get Social Security and you'd been getting it last year, well, they would have to go forward. They couldn't go backwards and penalize you for taking Social Security when the law allowed you to take it.
So it would only affect new benefits moving forward. And we saw that happen when they changed the life insurance rules. Back in the 80s, life insurance was even more favorable for retirement planning than it is now, because you could dump so much more in for every dollar of death benefit, and it would all be tax-free. And they passed the MEC rules and the Tamara 7-pay rules back in the 80s to minimize the amount that you could put into the life insurance. It still works for many people. It can still be a very good tax-free way to accumulate wealth, but it's not as favorable as it was back in the 80s. Now, anybody that already had a life insurance policy got to keep it, and they had the same rules that apply. It was only for new policies that were issued after that law went into effect that did not have that.
So rest assured, if you convert to Roth, you're safe. Once that's done, same thing with the estate tax. If you have a 14, 15, or 18, or 20, or $50 million estate, and you take out the $14 million exclusion now, and it drops down to $7 million, that's okay. You've already used up your exclusion at the $14 million. They can't go back and rechange it. So that's one thing that you may want to really consider. If you're above the 14 or close to the 14 million, you may want to do some estate planning and get that out of your estate while you still have a chance, because once that law takes effect, you may not be able to go back and do that.
And we'll see what exactly ends up happening to change these tax laws. And again, if you go to our website, riskfeestaxes.com, and you can go now. And you can also go, if you hear of any laws that are being passed and you want our comments on a specific piece of legislation, you can certainly go there, and you'll get actual advice from real tax attorneys, not just some advisor that is not qualified to talk about tax law.
Yeah, we get that a lot. We get clients, in fact, this last week, we had a client that talked to Daniel and said, Daniel, I like that your email says this is tax advice. Because up until now, I've had an advisor for 30 years, and it's always said, this is not tax advice. This is not legal advice. Even though he was telling me tax stuff and legal stuff, it always said, this is not legal advice. This is not tax advice. But Daniel, when you talk to them, it actually is tax and legal advice.
Exactly. Now, what you're hearing on this show is not specific tax advice for you, but when you talk to us, and the advice that you get from us is actual legal advice, actual tax advice based on the retainers you signed with us to give you that information. So we do hold that and make that very clear. So it's different than talking to an advisor that might kind of comment on taxes, but it's not really their wheelhouse. So we do encourage you.
Can't stand behind it.
Exactly. We encourage you to go to our website, riskfeestaxes.com, and you can get your questions answered there. Now, what about this tax on tips thing? We get people ask us about this. No tax on tips. How is that going to affect everything? First of all, it has to be passed as a law. I don't know if it'll actually get passed or not, but if it does, my suspicion is it won't have that much impact on most people, even if you're receiving tips. Because most of the people that we've run across that are getting tips as a primary or one of the primary sources of their income, either they're not reporting it anyway, which they should be, but they're not reporting it because it's cash, and a lot of times people don't report cash tips. So then it's
not legal.
It's not legal,
and we're not advising it.
Yes, you're supposed to be reporting them, but let's face it, a lot of people in service industry do not report their cash tips. And so they are not being taxed now. So making them tax free just makes it legal, but it doesn't change how much tax is being paid.
But think about it. If it's not federally taxed, it may still be Social Security tax, Medicare tax. So this is a way for them to actually get more money into Social Security by making it federal tax free. But now that income is going to be applied towards Social Security and Medicare.
And so that could be one issue there. The other thing is, even if you're getting tipped on a credit card, that's usually going through the payroll service, and then that's also being taxed already. But many people are getting enough back in tax at the end of the year that they're really not paying much tax on those tips anyway. So I don't know that that's going to have a huge impact necessarily on anybody else, but your income is very high and a lot of it's coming from tips, and that could affect you. Now, Social Security is another area that's being talked about. Let's eliminate all the tax on Social Security. Now, I would love to see that because it's a tax coming out of my paycheck now, and so I don't want to pay tax again when I receive it, Social Security. And let's face it, a lot of people already are not paying tax on Social Security because their income is not high enough.
Yeah, and you'll probably never get back all the money you put into Social Security, because the whole idea behind Social Security is a large group of people trying to support a smaller group of retirees. But that's turned on its head now. There's a lot more retirees than there are workers, and it's happening more and more going towards that effect. So it's even Stevens now.
Yes, it's much closer to the same amount now that is supporting the retirees. So we'll see if that gets passed or not. But right now, if you have more than $44,000 of provisional income, which is half your Social Security plus all the other things, other income, and you're married, then 85% of your Social Security could be taxable. And that proposal would certainly make it all tax free. Definitely saves clients with a little higher income. It saves them a bunch of money on taxes. So we'll keep looking at the tax laws as they may change or as laws are proposed and maybe being signed soon. And we'll be happy to talk to you again. Go to riskfeestaxes.com. Again, there's nothing certain right now. Nothing is in stone yet, but you do know you could take advantage of the laws that exist today. And we still are in very favorable tax laws currently. So go to riskfeestaxes.com to find out how you can minimize your taxes today.
Yeah, and don't celebrate or live in fear based on what might or might not happen in the future. Let's look at what happened, what is on the books today, work on that, and we'll work on the future later.